Welcome back. It's a big week for tech earnings with Microsoft, Amazon, Meta, and Alphabet all on deck. And with rates near 16-year highs, the street will be watching for the impact of those rising yields. Deirdre Bosa joins us now to discuss, Deirdre, how they've been hitting or maybe not hitting the sector.
Yeah, I think more like not hitting, at least on the mega cap side. I mean, the mega cap tech companies have really become defensive plays. They have these huge cash piles that are earning yield as rates go higher. Their growth at a reasonable price, GARPy stocks. So they're relatively safe in this kind of environment. But at the very other end of the spectrum is the startup world, and it's undergoing a sea change at the moment. Funding has come down, and really they're hit by interest rates because, one, valuations come down because the current value of their future cash flows, that's worth less when rates are higher. And at the same time, their borrowing costs are increasing. So that is really a double whammy to this part of tech, and that's leading to more startups shutting down. Now, what you're looking at right now, this is from Carta. It's a company that helps startups and VCs manage equity or cap table related activities, and it found that nearly 550 startups have closed shop this year. That's more than the 467 for all of last year. And it basically concludes that this has already been the most difficult year for early stage companies in at least a decade. Kelly, I was talking to a CEO who is the CEO of AngelList, and he sees similar data, and he says that it could get worse before it gets better because of those interest rate dynamics.
No, and I think I loved the way you summarized it. You know, big companies can shrug it off, but and not necessarily the stock prices, granted, but they can largely shrug it off. But for startups, this is a real game changer.
It is. And I want to mention one startup, which is really like the highest profile, one of the highest profile examples so far. It's called Convoy. It's a trucking startup that was backed by Jeff Bezos and a few other very, very high profile investors. Just 18 months ago, it raised $260 million at a nearly $4 billion valuation. It was on track to bring in $1 billion in revenue annually, and it just completely went under after rounds of layoffs. The CEO essentially told his staff that their strategic buyer couldn't do it anymore. And that's really an indication, too, of how even if you can't raise money and you have to look for a strategic acquisition, sometimes more and more the acquirers, the formula doesn't make sense to acquire a money-losing company because they can earn more just by holding relatively risk-free treasuries. Yeah, this has major implications across Silicon Valley for the private equity industry and for so much more. So also interesting to point out, though, that we are seeing this historic collapse in the freight market that is not helping matters right now, and nor is it a great sign for the economy. Real quickly on the cash piles here, just speaking of making more by doing nothing, a lot of big tech now benefits from that situation as well. Isn't it kind of amazing how that whole sort of complex has shifted? When rates were near zero, it was kind of seen as a liability that they were holding all of this cash and weren't doing anything with it when it wasn't earning or yielding very much. But now look at those cash piles. Apple is sitting on $167 billion in cash and investments as of last quarter. Alphabet, $150 billion. Microsoft, $120 billion. Let me put it this way. If that cash is yielding 4% at a minimum in the relatively risk-free treasury market, that's now nearly $7 billion coming in the door at Apple annually before it even sells a single iPhone.
Wow.
So it's just bringing in money. But what we could see, though, is more calls to distribute that cash to shareholders who are looking at those cash piles and saying, hold on, we should get a bit of this back, too.
That's a
so
great
that
point.
could be a topic this earnings season.
All right, Deirdre, thank you. We appreciate it very much. Our Deirdre Bosa reporting.